Good morning. For those who don't know me, my name is Renee Guillen. I'm a Deputy Director here at the League of Arizona Cities and Towns. I want to thank you guys for joining us today and joining us at the conference. I hope you're enjoying yourselves. Weather's a little bit better, a little less Amazon rainforest today, so that's good for a big man like myself. I'm not completely drenched yet. I want to thank you for joining us today on our session for an update on PSPRS and to talk about the tools to help cities manage their plans. Just a reminder that the presentations, both individual and one combined presentation, are actually available on the League's website, along with the Attendify conference app, and that also includes biographical information as well. Please turn off or silence your cell phones. And then I just want to make sure everyone knows we got a lot to cover. We have some really good information. We have a lot of good information to cover, so I'm going to remind our panelists to be as quick as possible because they're potentially keeping you guys from lunch, and also let you guys know that PSPRS in particular have a booth, and so they're available, I don't want to say 24/7, but they're available during the conference, and then same with PARS and with Stifel, they're going to be available. They'll be around the conference to ask your questions, and they have a lot of good information and assistance they can bring to cities and towns. And then I'm just going to do some quick introductions, and then we'll get underway. We have Scott McCarty, the chair of the PSPRS. We have Harry Papp, a trustee and chair of the investment committee of PSPRS. We have Maureen Toal, executive vice president with PARS. We have Mark Reeder, managing director for Stifel, and we have Omar D'Agostini, managing director for the Chicago office of Stifel. And so with that, I will hand it over to Scott.
Renee, thank you. Good morning, everybody. Thanks again for joining us. I see a lot of familiar faces. I know we missed last year's conference, but from the systems perspective, we've really been doing a lot of really great things, and we're pleased that Renee's given us some airtime today to share that with you. We have a host of experts here. We've got the PSPRS staffs up front. I'll introduce some of the trustees in a moment, but I've been associated with this system for probably 10 or 15 years. This is as good as it's ever been since I've been involved in it. We are headed in a very good trajectory, and it's because of a lot of hard work by a lot of people, yourselves included. So we look forward to sharing the information with you this morning. We're going to stop and take questions. If you have a question, please raise your hand. There's a mic. We want this to be as interactive as we can. I'm going to start, just talk a little bit of high level about some of the things we've accomplished, and then Harry's going to follow and talk about the investments and what he's doing with the money and the returns and some things like that, and then Maureen and the folks from Stifel will add some context as well. So a little bit just quickly about who we are. We're the public safety retirement system for the state of Arizona. We've got 3 defined benefit plans: public safety, corrections, and the elected officials. Our financial information for June 30th, 2021 is not out yet, so we've got up here the 20 information. The 21 information will probably be out in the next 2 or 3 months. We expect it to be headed in the right direction, and you'll hear more about that as we go through some of the numbers. And we really had a good year last year. I want to take a moment here, and there's 2 things from my perspective that have really helped the system get where we are. The one is when we did some reform a couple years ago, we added to the number of trustees on the board. We now have a 9-member board, and prior it was a 7-member board. And it's a mix of employers and employees that represent that board. We have several of the trustees here. We've got myself, we've got Harry in the back, we've got trustee Chris Hemmings. Chris, can you stand up? Chris works with DPS, and we have trustee Brian Moore, who's a Phoenix firefighter. And then right on cue, trustee Scheinert is just walking down the main entrance here. So Dean, thanks for that. That was perfect introduction. So my point here is you have 5 trustees here. This is for them, for a lot of them, this is their first time at the League conference. We're trying to be real visible and be engaged with the stakeholders. So my personal thank you to all of them for coming and participating and interacting with you on a one-on-one basis. Part of the success of our system has to do with our committee structure. So it's for you, it's a lot like your planning and zoning and your transportation committees. We have 3 very functional committees. We have an investment committee that Harry chairs. We have an operations committee that deals with a lot of the logistical things and member benefits and member outreach. And then we have a defined contribution committee that manages our several defined contribution plans. And then the second thing that really, I think, made a difference when we did the reform is through the legislation we created the advisory committee. So the advisory committee is a 10-member committee. It has representatives on the employer side, so Tom Belsey from the League sits on that, and it has representatives from the employee side. And we, the board, lean on that group to help us with some of the bigger policy issues that we're dealing with. So if we're dealing with some payroll assumption changes and actuarial assumption changes, a lot of that work starts with the advisory committee. They're very much engaged with the frontline stakeholders, and we lean on them a lot to get some input in our decision-making process. And that group really didn't exist 4 or 5 years ago. And you'll hear some about some of the good things they're doing. So our committee structure really is adding a lot of value to what we're doing. Here's a list of all the stuff that we've done over the last couple years, and I'm not going to go through every bullet. But as I alluded to in my earlier comments, the culture of the system is in really good shape right now. We've got tremendous staff that's sitting up here. We've got really hardworking and dedicated trustees that are just really doing some good things. We've made some changes on the financial side to improve the condition. You all, over the last year or so, are starting to pay a lot more money. You're doing some debt issues to really help out with that unfunded liability. So everything is coming together, if you will, very well, and you'll see some of the results of that. Specifically, we've taken action through the board, changing some actuarial assumptions and some other financial decisions that have really saved over $1 billion, reduced our unfunded liabilities by over $1 billion. So we're trying to get those dials and those levers right so that this unfunded liability doesn't keep growing and we get some sustainable contribution rates. So some of the big things we've done is we've hired a new audit firm. We've hired a new actuary a couple, 3 years ago. We've created an employer modeler, so at your finance director level, they can go in, plan specific to you, change some of those assumptions and see what happens to both your contribution rates and your unfunded liability. So hopefully your staff is using those. That's a free tool that's available to all of our employers. And then as I alluded to earlier, through the advisory committee, we have made some changes to some of our assumptions that are embedded in our pension funding policy, and that has served to, yes, increase contributions in the short term, but also in the long term, stabilize those contribution rates and start to knock down that unfunded liability by over dollars. In terms of what we're focused on right now, Harry will talk to you about where we're headed with investments given how he sees the market. We're focused on stable and sustainable contributions for the employer. We've still got some dials to, I'm having problems with my mic. Can anybody still hear me? Can I just keep going? Standing behind you and touching parts of you in public. So I don't know what to do. I tell a joke.
You just put it in your pocket.
What? Okay, sorry about that. I got more stuff in my pocket. I don't know. All right, how you doing, everybody? All right, I'll keep going. So I was talking about the 2021 priorities. So we're obviously aware of the sensitivity of the costs that the system has on the employers, so we're focused on that. But we also have a lot of things internally that the system needs to catch up on. A lot of our technology is not where we need it to be to serve our members, so we're spending some serious amount of money on some software, on a new pension administration system. And it's real important for the board, just like it is with you all, to really support your staff and give them the tools that they need to serve the citizens. We're making that same kind of investment here internally. And then the other thing we're doing is a lot of time and effort historically has been spent on tiers 1 and 2. Those are our legacy tiers. But just as importantly for us with the reform that happened a handful of years ago, we want to make sure tier 3, which is where all the new employees are coming into, we want to make sure that system and that tier is functioning not only as it was designed, but if there's the first sign that that's not operating like it was intended, what are we going to do about it and take action so that we, quite honestly, we don't ever put ourselves in a situation where we need a tier 4. The other thing that's real important to us is the relationships we have with our stakeholders and folks like you. Last legislative session, there was a Senate Bill 1649 that added some requirements to us about providing information to our stakeholders. We've got to do an annual report. We've got to do some stress testing, which is doing some hypotheticals about what would sort of break the system in terms of investment management and some things like that. And most importantly to me is we added 2 members of the advisory committee that are from the state legislature. And so again, that conduit for us, that advisory committee, is really, really important as sort of the place where those folks can roll up their sleeves and deal with the policy issues. So to have that sort of built-in relationship with the legislature, I think long-term is going to pay us some huge dividends. In terms of some tools for you, I'll do some numbers here and then I'm going to hand it over to Harry. But we always, when we speak to folks, want to remind you of what the tools are that are out there. One thing we've been talking about for years is, as best you can, is prepay your contribution in the fiscal year as soon as you can. We have a lot of employers that literally pay their entire amount July 1st or sometime in July. And the reason for that is you get that in the hands of Harry. He can invest that money and earn interest for a longer period of time rather than paying 26 times as you do payroll over the course of a year. The second thing that Maureen's going to talk about is we're giving you another tool where you can put some money aside internally in a trust that's dedicated for PSPRS, and you get to decide how that money's invested, not the system. And Mark and the folks from Stifel will talk about making some contributions through some debt to actually pay down either all or a big chunk of your unfunded liability. This is a chart of the history of the prepaid. So back in 2005, when we started pushing this idea, we had 3 entities make that prepayment. Fast forward ahead to 2021, we had 51 entities that paid the system already almost over $600 million, which is about a third of all the money we were expecting to get all year. So that message has caught on. If you're not doing that, talk to your finance director. It's a cash flow issue for you internally, but I imagine most of you can handle that. In terms of other ways to really knock out some of the larger unfunded liabilities, here's 4 of the tools we just talked about. Is maybe you can make some direct payments. We literally, the last day of the fiscal year, got $1 billion payment from the state of Arizona for their unfunded liability, part of their unfunded liability for DPS and for corrections. We've got some cities out there that instead of issuing debt to pay off the unfunded liabilities, they're taking some cash that they might have used to build projects, giving that to the system, and then they're issuing debt to actually build the projects. So that's another idea out there. We have several cities that have implemented dedicated sales tax, where they collect the sales tax and every penny of that incremental sales tax goes directly to their unfunded liability. And then Stifel will talk about a couple of the debt options that we've seen a lot of activity on over the last couple of years. Here's what some of these aggregate results have been. So last fiscal year, we got $1.6 billion in additional payments. A lot of that came from debt financing. And already this year, we've got $1.1 billion. And we're not even, we're barely through the second month. And 50 employers, who you'll see here on these next 2 pages, have paid us off. So a little bit of audience participation. Anybody their entity has paid off, could you stand up as a point of reference? Maybe they're not here because they already did this. But is there anybody here who's doing that? And you're from where? Douglas. All right, Douglas, great, thank you. So another resource that is a very complicated policy decision, but given the economic environment, we'd encourage you to have those discussions about the pros and cons of issuing a debt. But so for reference, there's slides here of who's paid off, and PSPRS staff is very knowledgeable about all these specific cases. Harry, with that, I'm going to turn it over to you and let you talk to them about all the things we're doing with the money.
Okay, thank you, Scott. Everybody here? All right. Was a fabulous year. We don't have the exact figures in yet. We have a substantial portion of our assets invested in things that are unmarketable, illiquid. These are private equity, private debt, and we don't get we don't get the actual results sometimes for 3 months. Apparently, we've got about 90% of the data in. The preliminary number, we didn't put it on the slide because we don't want to have multiple numbers out there, but it looks like the total return was about 27.8%, which is phenomenal. The market is doing just wonderfully, and the funds are being managed well. I'm going to go ahead and see if I can, there we go. Here's where the assets were allocated as of June 30th, 2020. And I'll tell you that the asset allocation is a lot different today than it was 4 years ago or 5 years ago. Part of that is because of the PBI. I think many of you are probably aware of how that caused PSPRS to have to invest with a lot less in equities, a lot less volatility. And fortunately, we got that changed. After we changed that, we changed the asset allocation. So our overall asset allocation looks a lot more like most public pension plans around the country. It's a good thing we did that because that allocated a lot more money to stocks and some more money to private equity, and those investments have really done well the last particularly 3 years. So we've got a good asset allocation. You can see we've broken down the U.S. equities, 23%. That's almost all indexed, just in the market index. We have about 17% in international public equity. We have buyouts, venture capital, real estate, and real assets. So you can see the bulk of the assets, the dark blue, are assets that we've invested in to try to get growth for the portfolio. We have to be careful. We can't put 100% in equities because the risk is way too high. So we need to have a balanced approach. And you can see core bonds on this. You can see the sliver there at 1%. If you picked, just pick 10 cities or states in the country 20 years ago, and I'll tell you what that pie chart would look like. It would have had 35% in bonds. And all our categories did really well last year, all except one. The bonds went down. Our bonds didn't go down as much as the index, but they still went down. They went down 0.4%. We have safer bonds that can't go down as much. But the thing that's really important is we only had, you can see at this snapshot in time, June 30th, we only had 1% in core bonds. If you took the average over the year, it was about 2.53% in bonds. So we had 2.53% of our money in something that produced a negative total return in the last year. But fortunately, we had the other 97.47% in things that went up. And some of the things went up a lot. Some of the venture capital, we had a couple of things that were up over 100%. We have secondaries, and we have private equity firms where we'll invest in a program with them, but we'll also co-invest directly with particular investments that they've identified. And some of those were up 60, 70% this last year, which is terrific. So the rest you can see, we have special credit and private lending. These are debt. They're very similar to a bond, but they're not publicly traded. They're not actively, you don't get an active price every day on those. And then we do still have about 13% in diversifying strategies. So we have changed the asset allocation a lot. We've moved a lot more to passive investments on the equities, and we're being really careful. So, as Scott told you, we've had an awful lot of contributions that have come in. We're delighted about that, but the question is, where do you put the money? We could just throw it into the market. And what I want to distinguish here is two different things that you could do. You see here that we had 23% in public equity. Well, the market can't go up. I mean, last calendar year, the market was up 20%, even in the midst of a pandemic. The year before that, it was up 30%. So it couldn't possibly be up this year, right? Funny thing, it's up 20%. Is it sustainable? We'll talk about that a little bit. But it proves to me that nobody can tell. Nobody can tell how the market's going to return and how it's going to be in any 1 year period. And that's not what you guys are invested for. You're invested for the next 20, 30, 40 years. And I'm here to tell you, if you want equity-type returns, you got to go to the party. You got to own the equities. And no one is going to be able to tell you when it's a good time to buy equities or sell equities. Now, we could say the market's overpriced. We could have done that a year ago. That would have been a mistake. And we could have sold 10% of the public equity. We could have done that easily. There's no tax cost to it. Transaction could be done in a day. And we could have taken money out and put it in the money market fund, wait till the market goes down, and then buy some more stocks, buy the stocks back at a lower price. That wouldn't have worked out very well if we did that last year. That is market timing. We do not do that. We are not smarter than the market. We know that. On the other hand, and I'll see if I can move this ahead. Oh, here's the returns. You can see 27% return for the fiscal year ended June 30th, 2021. Going back 3 years, 10.8%. Going back 5 years, 10.5%. 7 years, 8.2%. 10 years, 8.2%. Anybody see the black line on that? That black line is 7.3%. How many of these periods did we not earn 7.3%? That's right, none. Holy cow. It's been a great time to be in the market. Here's the value as of August 24th. You can see under the capital appreciation assets, we have 62% of our money allocated to things like the Standard & Poor's 500 index, which many of you probably have in your 401k plans or 403b plans or IRA accounts. We've got U.S. equities, non-U.S. equities, global private equity, other assets. All of these are intended to produce growth. Then we've got contractual income. We've got the core bonds. It's all the way up to 3.7%. We've got 9% in private credit, 3% in other assets, 9.5% in diversifying strategies, and look at that, 12.5% in cash. Now, we're not smart enough to take money out of the market knowing that the market's too high and buying it back when the market goes down. We are not that smart. We don't take those kinds of risks. But as the money has come in, we're very carefully deploying it. We know the stock market hit a new all-time high yesterday. We know interest rates are virtually at the lowest level that anybody in this room has been alive. That tells us some things about what's likely to happen going forward. In any event, we're going to deploy this money gradually, kind of like dollar cost averaging. Instead of taking one giant $2 billion step, we're going to take lots of little steps. We will not get the lowest possible purchase price. We also won't get the highest possible purchase price. We also have to be very careful on our private investments, on private equity and private debt. We have something called vintage risk. And if you put in a lot of money into private equity and you do it just at the right time, you're going to get great results. Well, if you do it just at the wrong time, you're going to get terrible results. So again, it's really important to diversify over time. One of the things we're able to do, if you've got smart staff, and we've got smart staff over there, one of the things you can do is you can go back in a time machine. And instead of putting $500 million in private equity today, we'll go back in a time machine and put $100 million in a year ago, and $100 million in 2 years ago, and 3 years ago. Well, how in the world do you do that? And the answer is you buy someone else's investment through a secondary offering. Now, you have to be careful because the guy that's selling 2017 vintage might be selling because he needs something changed in his pension plan or his endowment. That might be why he's selling. And if they just have a cash flow issue, that might be a very good time to buy it. It could be that they found out something about the 2017 vintage that it's not very attractive. Well, we wouldn't want to buy that. So we have to look really careful at secondaries where we're able to basically go back in time and spread out the vintage risk that we're taking. So we're being really careful with this 12.5% in cash. We normally run 2 or 3% in cash. We have a little bit of a cushion in that we had a great year ended June 30th, and we call the cash, if the market goes up, we're going to trail a little bit because we call it a cash drag because the cash is not going to go up. But if the market goes down, we'll be happy to have some money in cash. We're going to deploy this money gradually. We're going to try to do it opportunistically. We're not smart enough to take money out of the market, but we are smart enough to put it in, feather it in gradually, and try to do it as opportunistically as we can. So let's talk a little bit about market conditions. I got my first mortgage in Phoenix, Arizona at 12.5%, and I got a second mortgage at 13%. Okay, who's had a 12% mortgage? Okay, didn't feel very good, did it? And when you fill out that application, you pay a lot of interest. and it's not so easy to qualify for it. So the city of Wilcox, who would loan them? What would you charge the city of Wilcox for 15-year money where they're just going to pay you a certain amount each year, a certain percentage, and if they ever decide over the 15 years that they want to call part or all of your bond and take it back, they can still do that. What would you pay? 2.38%. Okay, so what's our assumed rate? You saw that black line, it's 7.3%. Can we make 7.3% over the next 10 or 15 or 20 years? Probably, maybe, but it's not for sure. We can't tell for sure. We're going to try. We're going to try to do better. And we're leaving no stone unturned to try to accomplish that, but we're being careful. Even if we only earn 6.3%, I'll be awfully disappointed if that's what happens. But if we do, and the city of Wilcox borrows at 2.38% and gives it to Mark, and he only earns 6.3%, they're going to have an arbitrage profit. This is a unique opportunity. Part of the reason the stock market is so high. So does anybody have a house? Has anybody seen houses in your neighborhood? Prices are way down, right? And houses, they don't sell very quickly? Is that right? Kind of like 2007, 2008. Remember that? Houses went up 40% a year. And we were predicting, not me, but people were predicting, oh, they'll go up 40% a year forever. House prices are very high today. Stock prices are very high. If you look at the price of a bond, bond prices are as high as they've ever been. The interest rates are as low as they've ever been. This is a unique circumstance. When I studied economics in college and in grad school, we were told, and it is correct, that over most of time, over many geographies, different countries, interest rates eventually get to whatever inflation is, plus 1 or 2% per year. Anybody bought anything lately? Anybody notice prices are going up? It's not just gasoline or lumber. There's inflation everywhere. Inflation, I'll just tell you, is probably currently running 3.5%, 4%, maybe more. The government tells us that, oh, this is all temporary. The price of timber is going to come back down, price of oil is going to come back down, and maybe it will. Well, I think you're likely to see at least 2.5% or 3% inflation going forward. So just say 2.5%. And instead, add 1 or 2% on that, just add 1% on. So let's agree that inflation may be 2.5%, add 1% for some kind of real return over inflation, you get to 3.5%. The yield on the 10-year Treasury this morning was 1.29%. The yield is artificially being depressed. Who is doing this? The United States Treasury and the Federal Reserve. And the Federal Reserve has $8 trillion on their balance sheet now. They're buying $120 billion of bonds every month. You've heard about the taper. That's what they talked about in Jackson Hole. They're going to gradually reduce how much they're buying each month. They're going to announce that at their September meeting on September 22nd. They're going to announce it. They're not going to start it. They're going to start it in October. And by June of next year, they're going to be done buying bonds. They won't necessarily raise interest rates, but they'll stop holding the interest rates down as much as they are right now. My prediction, mine alone, is that people will eventually figure out that the inflation, a good bit of it, is here to stay. If they do, they're going to demand higher interest rates. There's a guy, Bill Gross. He had a reasonably good record for a pretty long time. He's done some crazy stuff lately, and that's how he got fired from PIMCO, where he was one of the founders. He was walking around the office saying, I'm the greatest racehorse that ever lived. I'm Secretariat. I don't need any of you. I can do it all by myself. Turns out he was wrong. In any event, he's quoted this morning as saying, bonds are garbage in terms of investments. They produce almost no return at this point. And the interest rates, he said, can't go down. They have to go up. If the interest rates go up, the value of the bond will go down. The rates should go up a couple of percent here over the next year or two. And that means the train is leaving the station on the project, on what we're about to hear from Stifel. And you can issue bonds today very inexpensively. The other thing you need to know, if you're the city of Phoenix and you have $2.1 billion of unfunded pension liability, when Moody's or Standard & Poor's comes in, they look at that $2.1 billion of unfunded pension liability, and that is exactly equivalent to a $2.1 billion general obligation bond. They look at it the same. And so if the city of Phoenix will go out and borrow $2.1 billion, you might think they'd have an extra $2.1 billion of debt. But if they use that to retire, to pay off the $2.1 billion unfunded liability, it's net neutral. It's not like issuing incremental bonds to go out and do lots more projects that need to have debt service going ahead. So this is a unique environment. It's probably not going to last. As inflation, we're going to learn over the next 3 or 4 months that the inflation's not going back to 1 or 1.5 or even 2%. Investors are likely to demand higher interest rates, and when they do, the rates will go up. And if Wilcox can issue at 2.38 and give it to Mark, and he'll try to make 7.3, maybe he only makes 6.3. It's still a very good deal. If City of Wilcox has to pay 5% to give us the money so that we can earn 7.3 or 6.3 or 8.3, that's not enough margin of safety. I wouldn't do that. So the message is, go back to your communities, look at what you buy. This is Labor Day weekend. Go out and buy something. Whatever you buy, see how much it's gone up in price in the last year. When everybody figures this out, the interest rates are going to go up. And once they go up enough, this opportunity is going to close. So it is really important to do something now, and the message is we're being really careful with the money. We're getting great returns. The PSPRS is well structured at this point. Some of the things that happened in the past are not happening anymore. We've made lots of changes, and there's a great opportunity to go out and borrow money today to pay down these unfunded liabilities. And with that, I'll take any questions.
Yeah, maybe stop there for a second. Does anybody have any questions for myself or Harry about where the system's at with the investments?
Philgood, Mayor-elect Prescott. Can you translate your total returns into net of fees returns so we can have a better understanding of what the true bottom line is?
And the answer is about 1% in fees, a little less, but they're very difficult to calculate. And if you, I think there's going to be a football game. Is it tonight for ASU? Tomorrow morning when you read the paper, you might like it, you might like the outcome, you might not. But everybody who reads the paper tomorrow is going to agree what the score was today. There's going to be no disagreement about that. We're going to know what the score is precisely. It turns out if you buy a Vanguard Index 500 fund and you pay 3 basis points, it's pretty clear what the fees are. With some of the more complex investments, there are additional fees that go to the manager depending on how the asset performs. And I will tell you that CalPERS and CalSTRS and many pension plans report these additional fees in many different ways. So the answer in general is about 1%, a little less than 1%, but it's very complex to measure, and you can't just compare one retirement plan's fees to another because they count differently. Does that answer your question?
Somewhat. So PSPRS has historically been known for having one of the highest fee structures in all the public pension systems throughout the country. So at least can you talk about the change in your fee structure over maybe the last 3 or 4 years?
Sure.
Because you've been in venture capital and more increases in private equity, and some of the private equity with carried interest in some of these other areas are pretty challenging to end up with a reliable net return.
Well, what you say is exactly correct. These asset classes are much more expensive, much more expensive. And I will just tell you that over the last 4, 5, 6 years, thank God we were in these, because our returns in those more expensive asset classes have been outstanding net of fees. What we have been doing is shifting more of the assets to plain vanilla commodity index funds. So we have more money, a greater percentage of our money is in public equities, and almost all of those are in index funds, which are ultra low cost. So you're correct. You have to be very careful when you're going to invest in these things. You better not have somebody that's in the bottom quartile or the bottom half. If you're not in the top quartile, you shouldn't be investing, because the fees are very, very high. We've had good results, and if you'd like someday, I'd be happy to walk you through what the net returns have been on some of those more expensive asset classes. But take my word for it, they've been well justified. We're dollars ahead for being in those. But to your point, we are reducing the overall average cost by putting more money in public equities, a higher percentage in public equities, and putting those in index funds that are ultra, ultra inexpensive.
One more question, and then
So consequently, your net fee should be ratcheting downward.
Yes.
And you'll have your consolidated annual financial report available by 1st of October?
Well, it's around the 1st of December, I think, or the 3rd of December.
3rd
But-
of December?
Yeah, that's how long it takes. But it's in the CAFR, and if you'd like to visit someday, I'll be happy to walk through it with you. You will be stunned when you see the net return on the asset classes that are more expensive to operate.
let's go ahead and take one more question, and then we'll get to the rest of the panelists. Thanks.
Thank you for taking my question. My name is Joe. I work for Taylor and Snowflake. I'm grateful that you've pointed out the entities that have paid off their unfunded liability. As a citizen, I hope that those entities did not just have cash sitting dormant in their coffers. I'm grateful for the current leadership for PSPRS. My confidence in your ability to manage the situation is much higher than it was in the past. If my town chooses to pay off their unfunded liability, what assurance do we have that new liabilities will not be added on? That is a concern that if we pay it off, that we'll get a note later on saying, hey, by the way, you actually owe additional $1 billion.
Thank you. That's a great question. And paying, quote unquote, paying off the unfunded liability here, it's not a one and done. If you issue enough debt to pay everything off today, or you take cash that's sitting unutilized and pay all that off, it is possible in the future that if our returns are less than the 7.3% assumed rate going forward, you'll have additional expenses. If our returns are greater than the 7.3%, you'll find that you'll be overfunded. We're actually talking about how to deal with that with some entities that are, we have a few small employers that are heavily overfunded at this point. But your question is good. It illustrates that it's not one and done. All you're doing by borrowing money to pay off the unfunded liability today is fixing most of the prior expense, the liability that has built up. You could get additional liabilities going forward, but they're likely to be much, much less if we take care of the past unfunded liabilities.
Great segue to Maureen, we've got a tool here to help the cities manage those changing liabilities. Maureen, I know we're running short on time, but this has been a good discussion. So if you could jump right to the key points and tell them about the tool that we created. Maureen's the contract provider that we've hired to manage this set-aside trust.
Thank you, Scott. So as Scott mentioned, PARS, Public Agency Retirement Services, we've been hired by PSPRS to administer this new trust program called Arizona Employers Pension Pre-Funding Plan, AEPPP. So it's a mouthful. It's just launched in July, and it's another tool available to cities and towns to fund and manage their pension obligation, and I'll explain it in a few minutes here. Before I talk about this program, I want to just go over what the funding options are. Some of it Scott has discussed, but that are available to you. One is to make additional discretionary payments into PSPRS. You can pre-fund, set aside money in a contingency reserve account, a budget account, earmark money for pensions. Some of you are doing that already. Some of you are issuing debt, pension obligation bonds. You can do that. Now there's, as a result of legislation that PSPRS got passed in 2020, there's the ability to set up at the local level an IRS Section 115 pension pre-funding trust, and that's what this program is. And then all this can be used in combination with each other, so they're not mutually exclusive, and I'll explain that. You might ask, what is a Section 115 trust? Some of you may know, but in essence, it's an IRS code section that allows governments to set up a trust for an essential government function. And we went to the IRS in 2015 and asked, can setting aside funds for pension be deemed an essential government function? And the IRS said yes. We gave them our trust documents, and they said you can use it. And since that time, a number of local governments have started to use this concept. So it's a newer concept, and I think PSPRS is on the cutting edge of doing this. So what is this particular program, AEPPP? As you can see from the graph there, it depicts prior to this program, you could send money from your general fund into PSPRS. Now you have another option. You have a trust account. So this is a locally controlled trust. It's owned, in essence, by the participating employer. It's separate, operates separately from PSPRS. Distributions can be made from the trust directly to PSPRS. Any employer that it participates as a member can use this trust to invest their funds. So it's really important about the local control and flexibility. The city or town controls the contributions in. There's no limits on that. The disbursements out, when, how much, and the investments. And the investment providers with this program are separate and apart from PSPRS. So U.S. Bank is the trustee custodian as well, because it can do investments, and we have specially designed strategies with Vanguard Institutional Advisors Pension Group out of Philadelphia and Scottsdale that have set this up. So what's the difference between a trust and a reserve or a budget account, where you set aside funds for your pension costs? So under Arizona law and under this legislation that was enacted, as long as it's in a trust, you can diversify investing, so you're not relegated to general fund investing as you would be an account. What does that mean? That means that you can achieve longer-term earnings that are better than you can, say, if you put it in a investment pool, general fund investing, which you're making, under 1% right now. So it enables you to achieve greater earnings. We talked about inflation. So that is one of the reasons why local governments will set these up. So you can use it for short-term or long-term investing. So you have much more flexibility in that regard. And you can diversify. You can diversify the investing. It's irrevocable under what the IRS approves. So that means that it's dedicated solely for pension costs. It cannot be used for other costs. So it's not revocable as sometimes budget accounts can be. So once it's in there, it's protected, it's safeguarded. It can't be accessed for other uses, unlike a budget account. It's protected from creditors, so a trust is an exclusive benefit trust, meaning it's for the exclusive benefit of the employees, retirees, and beneficiaries. And so that means it's protected to extent that other funds may not be. And you have a corporate trustee, in this case U.S. Bank, that makes sure that the trust is operated for the exclusive benefit, the purpose it's supposed to. So that is a fiduciary protection for, councils and staff to make sure that it is properly administered. We talked about how it could be used potentially with, say, POBs or COPs. This is an example of what the city of Tucson did, and they put proceeds from their bonds into the trust. And over time, they're going to send it on, to PSPRS. You can put some or all of it. You can don't put the bond proceeds, but take savings. Some of our clients put savings from it in there. And so this is an option for the trust. So you've got a concept of what this trust is, but how do you use it? How would you use it? And it varies to a great extent. There's over 300 or so cities, towns, and other types of public agencies using it right now, so we're learning a lot about how they use it. But in essence, what it is a way to stabilize your pension costs. So you're setting aside funds that you can use to pay contributions. You can decide 1 year we're not going to pay from our general fund. We're going to take the money from the trust, pay it onto the system. You can make extra contributions with it. Some will take when there's it to mitigate rate volatility. They'll take, the delta, the increase in the contribution rate, and send it over. So it's oftentimes used to mitigate volatility. And earnings, we talked about the diversification. You can use earnings from the trust to help you with your contribution rates. So that's important. And I think the key thing here is the local control and flexibility. You can diversify, you can invest differently with those funds that you're eventually going to send to PSPRS in a way that you want to do it. And so the idea here is to offer different options. It's not one approach to investing. It can help improve your credit rating. We've seen that a lot of our clients that are using these trusts, it's being used as a factor in their credit ratings because it's a prudent thing to do to set aside money and protect it for future pension costs, which is a significant cost for you. As I mentioned, protect from diversion for other uses. That's an important thing, and I mentioned using with a bond funding strategy. Some will say, once my funding level gets lower than a certain amount, I'll send funds on to PSPRS. What happens if the discount rate, as is happening with public pensions across the country, decreases? Then you have funds for that. So there's a variety of ways to look at future cost and prepare for it. And as I mentioned, it really is rainy day. A lot of our clients will say, I'm waiting, I don't know when I'm going to use it, but I'm waiting to use it when I need it. So we've had, local governments funding in for over 6 years now, and some of them haven't taken a cent out. What we're finding right now is a lot of them will put one-time monies, just fund it with one-time monies that they don't want to be used for ongoing costs. And so it's a source for that. So there's a variety of approaches to using it. And then in closing, I wanted to explain who the providers are. So PARS is the administrator. We would be the point of contact for you. We have signature-ready documents prepared, approved by the state, as well as federal law, the IRS, and we do all the compliance on them. We have ready-to-go documents that makes it easy for you. Our experience is we have over 450 Section 115 clients, and we have over 240 using it for pension right now. So we have quite a lot of experience, and Charlie, my colleague here in Arizona, both of us come out of city government, and we can meet with you to talk about it. But we have about $5 billion right now in these trusts, so they're growing significantly. U.S. Bank, as I mentioned, is the largest trustee custodian of Section 115 trusts in the country, and so they safeguard the funds and make sure that they're managed properly. And they can operate as a discretionary trustee where they can manage monies on a customized basis for you. And then, as I mentioned, we had set up some strategies with Vanguard for this trust, and we basically said to Vanguard, we want you to come up with various options. We have a conservative, a balanced, and a growth. We want it to be as low cost and low fee as possible, and we want an economies of scale fee schedule. And so whether you put 10,000 or 10 million in there, you get this fee schedule. Right now, it's at 2.3 basis points for investment advisory costs, and it's dropping. It keeps dropping. It's dropped by about 60%. So the idea here is we want to design it so that small, medium, or large can use it. And so we tend to find like the smaller and medium-sized ones like to use it. But under the fee schedule, it can go down under 1 basis point, which is just incredible, regardless of how much assets you have. So anyways, I mentioned we also have some flyers here, and we'll be at the booth if you have questions, and we'd be happy to meet with you.
Thanks, Maureen.
Sure.
And again, we're running a little short on time.
Yeah.
We got a late start, but Mark, if you want to, I think Harry set you up real nice. If you can, for the folks that are in the audience and really thinking about doing some kind of debt issues, maybe the 3 or 4 things that they need to think about, and that would be very helpful. And then we'll get you out of here and get you to lunch.
There we go. Thank you. Good evening, good afternoon, everybody. Good morning. Mark Reeder with Stifel. Thanks for attending the session. We have the privilege of working with most of you in the room on your public infrastructure bond issues, as you all know. We help you finance your roads, your bridges, your utilities, general public infrastructure. Been doing that for a long time. Over the past couple of years, as this Tier 1, Tier 2, which is what we're talking about today, PSPRS, unfunded police and fire pension liability over the years has grown on your balance sheet. And I encourage you to read your audit. I was just reading an audit this morning for one of our cities, and the pension section of our audit was 30 pages. We know it's a very complicated subject matter for all of you that you're having to deal with on an annual basis in your budget sessions. It's been a growing liability, as you all know. So what's happened as we go into the market and sell your bonds for you, the past several years we've been getting more and more questions as to why the Tier 1, Tier 2 unfunded liability in our state is growing. We've been, we get questions from the credit rating agencies, and we've been getting more and more questions from investors around the country as to why, what are our cities and towns, and what are our counties, and what are our state agencies going to do to address the unfunded liability on your balance sheet. Most of you in this room, it is your largest debt on your balance sheet. It's even larger than your municipal bond issues that we go out in the marketplace for. Not everybody. So as a result of that, we're starting to get a lot more questions. As you all know, this debt is constitutionally protected. It's on your balance sheet, and you are required to pay it from a constitutional perspective. So I wanted to kind of give you a reminder of that background as a municipal issuer of bonds to finance your public infrastructure, how this has become an issue, and it's a growing issue. So we have a pie chart up here. A lot of you have seen this pie chart. We've been in the room with you. This is the statewide Tier 1, Tier 2, not Tier 3, right? We had some constitutional reforms that have helped correct a lot of this, which is really good, but we're still dealing with the Tier 1, Tier 2 unfunded liability. And on this pie chart, it's about $12 billion. This is June 30, 20 numbers. It's gone down because of some better returns and some bond refinancings. It's about a $12 billion problem in our state, okay? Now, the green is our cities and towns. I'm going to round here, if you don't mind, about a $7.5 billion unfunded pension liability in our state, okay? PSPRS is not like ASRS, because you're all in the ASRS program, most of you. That's a pooled program. As you know, the PSPRS program is what they call an employee-funded program where the assets, you all have individual assets for your police, and you all have individual assets for your fire. And those assets in those individual accounts have to pay the present value of the liabilities going forward, right? So we chatted about this a little bit. The statewide average is about 47% or so funded. All of you are in a different funding level, okay? It's all over the map. The statewide average is about 47%. We have one client who has asked us, just to give you an example of the magnitude of the issue, we have one client around the state that's about 6% funded. They have $600,000 in their account, and they have $10 million in liabilities that's constitutionally protected. So they're obviously in a different scenario than a lot of you in the room, but I just wanted to share that with you relative to the magnitude of the problem. So let me just kind of share a few things with you how all this got started. And I'm going to go fast. And Scott, how much time do we have? I want to make sure. Okay, I need to give Omar 5 minutes. Can I do 3 or 4 minutes and give Omar 5 minutes? So we apologize for going over. City of Flagstaff's one of our clients. They called in May of 2020. They were $125 million unfunded. They were frustrated with the growing liability, and they asked us what we knew about these pension bonds. And you've all in the room probably heard about them in the country. Arizona had never done a pension bond. So when I got that phone call, I told them I don't know much about pension bonds. So I brought in my colleague Omar, who's out of our Chicago office. He's been doing this all around the country, and off we went. And so since I'm really out of time, what I'm going to share with you here real quick, because I do want Omar to get 5 minutes, what I want to share with you is in the state, as we've been in the room with each of you in your communities, you all have options to address this option, this unfunded liability. It's a worrisome liability, so how do we fix it? Well, Prescott, the gentleman from Prescott here, they passed the sales tax. Fantastic. Charter City got approved, and they're using that sales tax revenue stream to pay down that liability. Not a lot of our cities are doing that. Okay, there's a few other options. Cities could do a property tax bond. They don't really want to do a property tax bond, right? The other option, as Scott and Harry and others have mentioned in the room, you throw more contributions out each year to start chopping that mountain down. That's another option, right? There's an option of doing nothing. If you do nothing, you're probably going to have a growing liability because you got a 7.2% accrual rate on your unfunded liability. And then the last option have been these pension bonds we've been doing, okay? So on this chart here, we've done pushing 30 of them all around the state. We've raised $2.5 billion with a B. Several of our clients are in the room here. And we have transferred $2.5 billion to PSPRS, and they're putting the money to work. Their fund grew. They're doing a good job on their returns. And most of our cities, as mentioned earlier, are now 100% funded when they do a pension bond, okay? What I wanted to share with you, Harry hit on this. I don't have a lot of time here. Just about all of our bond issues have been in the 2% money range, okay? Flagstaff was 269 in May of 2019. We shared Wilcox, they're down in the 240s. Casa Grande did a really nice transaction with us a few weeks ago at 2.16. So the cities that are choosing to look at this option have retained us to assist with all the math and all the economics and what is really the benefit of doing a pension bond, what are the risks, and then the really cool thing that they really like about it is they can really level out their amortization. And some cities, if you have the budget capacity, can pay the debt off early. Flagstaff paid their debt off 6 years early vis-a-vis the amortization back to ASRS. So they had about $76 million in expected net present value savings. Was really a fantastic transaction. So I'm out of time. I wanted to kind of give you a real global overview of what's going on around the state. I wanted to thank a lot of our clients in the room. You guys have been amazingly patient as well as we've gotten you all up the curve in terms of the education process. So with that, Scott, 5 minutes?
Let Omar wrap us up.
I wanted Omar to come over here. Omar's out of our Chicago office. Now he's going to make you feel better. The unfunded pension liability in Chicago is?
All of it. Just the city alone is. Hey, good morning, good afternoon. Thanks so much for joining us. I know pensions is a topic that I've spent the last 20 years working across the country. Before, there's a number of slides we can go through, and we will get through that content quickly. I just want to tell you, in all those 20 years, under the leadership of Mike and Scott and Mark and the whole PSPRS team, in the entire country, I have never seen an executive director and board members and staff more committed to working employer by employer in terms of education and options, and really turning PSPRS into the epitome of best practice. In many instances, you'll see a lot of good press coverage for the Wall Street Journal and so forth. I know this because I'll get questions from the chief financial officer of the city of Chicago, from the treasurer of the state Commonwealth of Massachusetts, all the time. What are they doing? Hey, could you hook us up with them to talk with them? So you should feel very good about that and very proud of that. I'd just like to say thank you to them. One of the questions here on page 13, a lot of times people are upset that there's a big liability. Why is it there? Well, there were some certain structural things for PSPRS, the PBI, the Tier 1 and 2 provisions, which under Scott's leadership and Mike, you guys were able to address in really good fashion. And that's obviously great news, and now you have something you can really work with. But nationally, this has been a trend where liabilities have been growing faster than assets. And the question is why? And so in a couple of pages, I feel charts are sometimes easier than words. I'm kind of a visual person. Number one, mortality. Since I've been doing this, and for even longer, every time the actuary comes to visit a fund, the news is always, we need to update the tables, the mortality tables. And as you can see from this chart here, back in 1983, people lived to 73 years old. By the time you get to 2000, it's 76.8, and it kept increasing all the way up to 2019. Those are, of course, that's great news for all of us and our families. It's awful news for pension math, and each one of those revisions has been a challenge. Now, of course, the last year is a little bit of a twist. There's a few things going on. We'll see if that is transitory or actually holds. But certainly, longevity, mortality, that has been something driving this liability. And of course, there are a lot of things. We could talk for hours about this, and I know I would be standing here alone. And I'm not going to stand in between you and lunch, so we'll keep it going. Benefit creep. Again, this is a national trend, right? Relative to COLA formulas. Things like a 13th check. The city of Detroit had that. I remember as a young associate when I said, well, gee, you can't borrow if you have the 13th check. They said, oh, great, we have a great solution. And I was fired from the account, thankfully. I'm always honest about those type of things. But again, benefit creep is something that has driven these trends nationally. Third one, transparency. This is actually a real lifetime footage of somebody looking at a pension actuarial report, which is sometimes good bedtime reading. It's something that has been arcane and difficult for people to read. It lags. It's hard for the average, city or town manager, finance director, and so forth to get their hands around, which again, I think I would turn to PSPRS, and many of the people in this room have kudos to really getting that education out there. And so it all gets to the question of where is the future? And so we'll take out our crystal ball right before lunch. A couple of things. One, relative to mortality, there's been a great movement towards moving from strict static mortality tables to generational ones that are more nuanced, that account for differences in your employee base. Those are things that you'll see PSPRS doing. There's also been that sort of reversion from the upward climb, some due to COVID, some due to opioid crisis and other health trends, and frankly, even the secular. There's only so many people who can quit smoking, which is largely what has driven the mortality improvements over the past years, if you're to look at the math of it. Hypersegmentation. I'm working in another state that is engaged, and their state population is quite different, and so they actually have a state-specific mortality table. Benefits, it's all about new tiers. You guys have already done that. You're way ahead there. And transparency. If you haven't had a chance to talk with some of the folks at PSPRS, I'd really encourage you to do so. You'll learn a lot. I always do. And they're really committed to spend time to help you with options, whether that is a debt option like the ones that we've talked about, or some of the other options that you might consider. There are many good policy options out there. I really encourage you to look at that. Also, in terms of modeling, your modeler is a really cool tool. I enjoy it. I think it is, again, helpful. And so, I think there's a lot of good things in the future, particularly as it relates to PSPRS. We're certainly committed to help advance those conversations, whatever route you go. I know our time is limited, so I will stop my remarks there. Scott, I don't know if you wanted to take questions or wrap up.
Thanks, and again, it's helpful for you all to hear the national perspective on what's going on here in the state. We are doing some really cool things. So for those of you that want to go to lunch, please feel free. I'd like to thank the panelists. We will, if anybody has a quick question, we're more than happy to ask a question at the mic, or we can take them individually after. Is there anybody that wants a question? Clark, you want to ask a question?
It's going to be a tough one, I can tell.
For those who want to get more information about Section 115 trust, we've got a webinar that's going to be on September the 15th. So that'll give you a little bit more time since we're pressed today.
Okay, again, thank you all for your time and your attention. Again, we'll be around if you want to ask us any individual questions. Thanks to the panelists for all your work. Greatly appreciate it.
Thank you.